Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Okay, so looking at our market today, we are closing right at that 200-day moving average level here. You might be able to just see that through in the red. Okay, so basically maybe 5 points above thereabouts. So we're just closing on those levels at the moment. They've tried pretty hard to push us through those levels, okay, today, but it looks like we could be failing. I think it's still a little bit unclear here. So let's bring things into perspective. A lot's changed in the last week. Basically, we've been stuck inside this channel for quite some time. Okay, the channel boundaries up here were more around the 71.80. In January, we broke below and we basically stayed below there for most of the time in the past few months. Okay, we know the pullback, the initial pullback was on fear of interest rates, and the second pullback was more focused around inflation and the situation we're having in Ukraine and Russia right now. But last week we broke back above that key level of 71.80, and we're now starting to see higher troughs across the board, and we're taking an attempt at a higher peak. Okay, if it pushes through this current resistance here, then we've got a higher peak, higher trough situation once again, and we'll start changing our view and be a little bit more fixated on this uptrend. If we fail from here, though, it could just be failing from resistance and easily get back down to around 7,000 given the backdrop we've got at the moment. So once again, key pivot points. We're in between trends, guys. There's no real key trend in the medium term right now. Okay, we had a very consistent channel from July last year all the way through to just after Christmas, after New Year. That changed. Okay, we had risks of a downtrend. Now we've got a potential of an uptrend or a new channel. Like we're just, I think that the waters are definitely murky out there right now. There's not a clear medium term trend. There's a lot to price in. There's a lot happening. Okay, so technically at the moment, I still feel we're kind of finding our feet of what's coming next. We're at another pivot point. If the 200-day moving average and this resistance breaks, and we start using that as support, the chances of an uptrend becomes higher and higher and higher. If we fail from here, I think we'll likely just channel for a while. Okay, I think that's probably the likely scenario, the way things are playing out at the moment. Coming across the S&P 500, okay, so that's the other thing I like to lean on quite a bit here, guys. They're also holding their 200-day moving average. We've got futures at the moment are down about 15 points on this index, okay? So from what I can see right now is we're likely to hold that as resistance right now. Everything I'm looking at in the short term is saying overbought. I do think we're going to find ourselves with a lower US over the next few days. I do also think this could be the bottom, but we may come back down and test that and have a play around a few times before we actually start pushing back up again. What you got to realize, guys, with these types of wars and things, the markets get quite volatile when things start. But once you're sort of in that midpoint, or you start, the markets start seeing, where it's likely to head, then people start buying back in again because there's so much more going on, right? You take the Russia-Ukraine situation out, we are in a post-COVID recovery mode. I'm actually quite bullish if you take this Russia-Ukraine situation out, guys. Okay, I'm actually quite bullish here. But there's still that bit of uncertainty, that bit of risk that could hold things back. My personal view right now, and I'm going to change that very quickly if the 200-day moving average breaks, I suspect we're going to have a small pullback and then another strong rally. Okay, I think we need to see a bit of profit taking from the current push up. That will then lead to a higher trough in the US and then a higher peak. Okay, so that's kind of where I'm thinking. I think we're going to head back into an uptrend, but we need a bit of a breather beforehand. Okay, let's start with the whole Fed situation. So we heard from the Fed last Thursday. We also heard from Jay Powell overnight. The Fed has increased rates by 0.25% and is flagging further increases in interest rates over the rest of the year. Okay, so expect basically a rate rise every single meeting. That's almost every single month. Okay, that's the expectation they've thrown out there, and they're basically throwing everything at this inflation situation. So, furthermore, the message we got from the Fed last night, though, is that it's not just to battle supply chain issues. They're also trying to make the economy just chill out a little bit here. Their view is that the economy is very, very strong. Okay. And what message should we take from that when we've got a sideways to bearish market and your Federal Reserve, the largest central bank of the world, saying that the economy is extremely strong? Well, that's going to send a message and start seeing people buy again. The forward outlook is very, very strong, yet we've had a bearish market. So the bearishness has come from fear of increasing interest rates. But the reality is when interest rates go up, okay, you tend to get some money flow out of bonds back towards equities, more riskier assets, because the general view normally is that you're going to be in a strong economy if interest rates are going up. The other thing is the function of the bond market, guys. If you're holding a bond and you're trading in and out of bonds, if interest rates go up, the value of bonds go down. So you will actually lose money if you buy a bond and interest rates go up. So you're better off in a cycle where rates are going up and you think inflation is going to persist and rates are going to continue to go up, then money should flow from bonds back towards equities. And then the flip side happens when everybody believes that that interest rates have topped. Okay, this is the highest level they're going to trade to in the near term. Then the flow will come back the other way, right? So whilst interest rates are going up, equities are normally bullish. It's just what part of the market do you want to be in? And the big thing here, guys, and what history has told us is in rate hiking cycles like this, especially while you've got high inflation, I would be going more towards value stocks, banks, energy, materials that are classified as value. Okay, there's plenty of that in the Australian market. Okay, BHP is a value stock, even though it has growth sometimes built into it. It pays a high dividend, it's steady, and it's been around for a very long time. I classify BHP as a value stock, where many stocks in the US are classified as growth, especially in the NASDAQ. So expect a lot of those NASDAQ stocks, especially young companies that are in high growth phases, to underperform in this environment. Things like Microsoft should start bouncing back, right? Microsoft is a very well-known company, been around for a very long time, proven concept, and has good, consistent growth. Okay, it's for me is more of a value stock. It's proven. It's actually a profitable company. Okay, whereas something a bit younger that's not profitable yet are still trying to build their client base and build a company in their younger phases of growth, they're the ones that I think will continue to underperform. Understand what I'm saying here: underperform, outperform. It doesn't mean these stocks won't go up, right? If the market goes on a nice rally, everything will go up. But value should outperform in this environment over the medium to long term. All right, Russia, Ukraine. We know this is what's happening now. We've got a path. Okay, it's an ugly path, but it's a path, right? We don't like what's going on over there, but at some point, the reality is the market will price it in. What we're going to watch out for is further escalations, and we're going to watch out for what happens in the commodity space. Okay, if crude goes to 180, as some people were predicting about a month ago, then we've got problems. Okay, big problems, because not only have you got the Fed increasing interest rates to dampen demand, the increase in energy prices alone will cause stagflation. Okay, so if crude hangs around here 110, 120, I think that's okay. It's built into the market, right? I think the market has now built that 120 mark in. We saw the 120 tested on crude last week, or was it the week before? And that's all corrected. That's fine. The market's built that in. In saying that, we've just got to keep an eye on the whole commodity space, okay? Agricultural goods, wheat, oats, all that sort of stuff, those futures markets, if they keep running higher on the back of this Russia-Ukraine situation, then we've got a problem. If gas prices in Europe keep running up, we've got a problem. If they all calm down and just go sideways from here, I don't think the Russia-Ukraine situation is going to be any worse for markets than what it is right now. Okay, the markets will be able to price it in. They won't be too worried about inflation. Yes, we're going to have some high inflation readings coming in the next few months. We know that, but we don't want it to keep getting worse from here. If we can find a top soon, the market's okay with it. if we're going to keep having hyperinflation over the next year or two, the market's going to have a problem with that. Okay, there's going to be some big problems coming our way. The everyday person's going to get squeezed. Discretionary stocks will fall. Staples will be defensive, and then we'll see what happens from there. Right. Okay. The other thing that we've got to keep an eye on here, COVID cases worldwide are starting to increase again slowly. But what we don't know is how bad things are getting in China because China doesn't report their numbers. Okay. So we know Hong Kong are going back into lockdown. But last week we found out that some workers are going to go back to their manufacturing jobs, and that eased the mood a little bit. I saw that Asian markets rise again a little bit from their lows. But the Asian markets are much lower than what we've seen our market, the Western markets, move. Okay, so Chinese markets have been hammered over the last few months. Okay, we're going to be watching them to see whether we get a bottom out or not. But there is a risk of another worldwide COVID wave, and it's just a matter of whether we'll see similar type of lockdowns as what we saw last year or not, and only time will actually tell. I figure we probably won't because there's been plenty of time for people to get vaccinated, and they're going to keep harping on about these vaccination levels and things like that. I think we'll see lockdowns, guys. I think we'll see restrictions, but I don't think we'll have stay-at-home orders like we've had in the past. I think people still be working. I think the lockdowns we see this year will be much less severe. You might start seeing dance floors and mask wearing and things like that rather than whole industries being shut down. That's just a prediction. We'll see what plays out. So I've already spoken quite a bit about inflation, guys. Okay, I'll just reiterate that just real quick. Keep an eye on those oil prices. We don't mind oil at 1 to 120. The market's priced that in. It's had a chance to digest that. What the market hasn't digested is a potential crude oil price of 150 or above. If we start seeing those big moves higher, then I think the market's going to get scared again. So, and that goes for agricultural products as well. I think the steel products are more positive. So, industrial products are positive for our market. If that keeps going up, our market will keep going up. Okay, so I think I'll leave it there, guys. They're the main points to be watching out for. Okay, technically, we're at the 200-day moving average. I suspect we're going to pull back. Okay, we need to take a breather here. I feel the market's overshot in the short term. I think that's going to lead to a very small uptrend. And I say that because we are in a interest rate increasing cycle. Money tends to flow to equities. And I feel that the value stocks could perform quite well here, especially if metals continue to increase. So I think the XJ will go into a slight slow grind towards 7,600 in the next few months, depending on how things escalate. And, in this environment where the waters are very murky, you're going to be happy to change your view on a daily basis almost, right? Because anything can come out tonight that's going to completely change everything that I just spoke about. Okay, so we're in one of those environments. There's heaps of different ways of trading this environment, guys. So, from a short-term trading perspective, that volatility can be very, very good once you understand it and know it's there. Okay, so this environment's actually pretty good for trading. Okay, I am being very selective with my trades now, and there's certain styles of trading I've switched to. Certain ways I set up my short iron condors and things like that in this environment. So if you want to talk about that a little bit more, if you need help with that, don't hesitate to reach out. That's what we're here for. Otherwise, guys, there's not much else for me to say. I hope you have a great week. Take care, and bye for now.